Hi, I'm Denise Anderson from IBEX Wealth Advisors, and I'm here to welcome you to our market and economic outlook for 2025. Good morning and Happy New Year to you all from our offices here in Bedminster, New Jersey on January 22nd, 2025. At the beginning of each year, we produce a video outlining recent economic and market performance, analyzing trends in growth, employment, and inflation, while also considering other factors such as government and monetary policies. Last January, our forecast for 2024 included a modest economic slowdown but not a recession, continued downtrend in inflation, another rally in risk assets including megatech winners from 2023, the end of rate hikes with modest rate cuts toward the second half of the year, and a resilient consumer throughout the year. A new year brings a new administration to office with potential policy changes including tax, trade, and regulatory shifts. Let's take a look at how all of this could potentially impact the economy and the markets in the new year after a quick look back at 2024. Despite uncertainty from the U.S. election, shifting monetary policy, and geopolitical tensions, 2024 was a strong year for both the economy and markets. U.S. equities defied projections, posting a second consecutive year of returns that exceeded 20%, a feat achieved only 4 times since the 1930s. These returns were driven by large-cap names, fueled by strong earnings, optimism around AI, and potential deregulation under the new administration. In September, the Federal Reserve initiated its rate-cutting cycle as inflation eased, starting with a 50 basis point reduction, followed by 2 additional 25 basis point cuts in November and December. Consumer spending, fueled by rising household wealth and 20 consecutive months of real wage gains, continued to power the economy forward to another year of above-trend GDP growth.
Any discussion of the economic outlook for 2025 must begin with a review of some very basic but essential economic fundamentals. This is a pretty important part of our video.
With a new administration taking office and a host of campaign promises and policy proposals on the table, it's important to evaluate how general policy shifts could shape the economy and markets in the months ahead. With consumer spending accounting for nearly 70% of U.S. GDP, make no mistake, the American consumer is indeed the goose that lays the golden egg, consistently driving economic growth and market performance. The healthy consumer thrives with a job to keep spending on the economy, low inflation, preserving purchasing power, and low interest rates to finance larger purchases. Overburdening the consumer risks weakening this crucial engine of the economy. Tariffs have been a long-standing U.S. trade policy tool used by multiple presidents to protect domestic industries. The Trump administration emphasized tariffs to support American businesses, and President Biden has largely maintained them. While tariffs offer certain economic benefits, they can also have negative, unintended consequences. Tariffs can boost domestic production and jobs, protect key industries, strengthen national security, and generate government revenue. But they can also lead to higher prices for consumers, retaliatory tariffs, supply chain disruptions, and inflationary pressures. Governments must carefully balance the use of tariffs to protect industries without triggering anything that could weaken the broader economy like inflation.
Legal immigration plays a crucial role in expanding the labor pool. By providing a steady supply of workers, particularly in industries facing shortages, immigration can ease labor market pressures and prevent something known as wage-driven inflation, a cycle that looks like this.
In a tight labor market, businesses raise wages to attract and retain workers. With more income, workers spend more, increasing overall demand in the economy. To cover rising labor costs, businesses pass higher costs onto the consumer by raising prices. As prices increase across various sectors, overall inflation accelerates. As the cost of living rises, Employees push for further wage increases to maintain their standard of living, thus perpetuating the cycle. The incoming administration must carefully balance tariffs, immigration, inflation, and monetary policy to support both the consumer and the broader economy. A steep tariff hike could raise costs, straining consumer spending, while a crackdown on immigration could tighten the labor market, driving wage inflation. Together, these forces risk fueling broader inflation and perhaps slowing or even worse, reversing the path interest rates have taken over the last 2 years. Thoughtful policy decisions will be essential to maintaining stability and sustaining consumer-driven economic momentum. The American economy appears to be very healthy entering 2025, and a relatively benign economic environment should offer investors plenty of opportunities to deploy capital. So let's start with the fixed income markets, otherwise known as the bond market. Strong economic activity and solid earnings growth helped corporate bonds rally in 2024, with investment grade and high yield corporate credit finishing the year up over 3% and 8% respectively. While this rally has left corporate credit looking expensive, we continue to find opportunities across the asset class. As to equities, also known as the stock market, it is important to recall that earnings drive stock prices. In 2024, S&P 500 earnings grew 9%, with forecasts of 15% and 13% growth in 25 and 26, though slowing GDP and easing inflation could pressure margins. While stocks known as the Magnificent Seven saw outsized gains, broader earnings growth is expected in 2025. With this greater earnings breadth should come greater market breadth, reducing reliance on mega-cap stocks and bringing a more balanced market leadership. While 2025 may not match 2024's gains amid inflation risks and geopolitical uncertainties, strong economic growth, corporate profits, and investment in AI should provide the ingredients for another profitable year. We will continue to employ our market-tested fundamental and technical analysis in all areas of your portfolio to help us find new opportunities and, of course, pare back any deteriorating positions. This should be another exciting year for the markets, maybe sprinkled with a little extra volatility to keep us all on our toes. We wish you continued health, peace, and prosperity in 2025 and sincerely thank you for the trust and confidence you have placed in our firm. We'll see you a bit later this year.